Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Three popular gold trading strategies when trading gold. Gold is one of the most precious metals that has been used as a store of value for centuries. That's why trading gold has become such a popular way to invest in the commodity market. However, to thrive in trading gold, you need a solid gold trading strategy. Let's examine three valuable gold trading strategies that you can use to buy and sell gold in financial markets. This article will also touch on things to consider before trading gold. Fundamental strategies. Fundamental trading strategies measure the intrinsic value of gold by its economic and financial factors. 1. Seasonal gold patterns. For short-term traders, one of the best fundamental gold trading strategies to follow is seasonal patterns. That's the beauty of trading gold. Gold follows a seasonal pattern and tends to rally during some months. During these months, gold prices have an above-average price. This pattern is primarily driven by the demand for gold during the festive seasons. Festivals such as Diwali and Chinese New Year are traditionally associated with buying gold, so gold prices tend to rise in the months leading up. Similarly, gold prices may decline in the summer months when demand for jewelry is typically lower. 2. Inverse gold prices and U.S. Treasury rates. Another fundamental strategy for trading gold CFDs is to monitor the inverse relationship between gold prices and U.S. Treasury rates. If you have a long-term trading outlook, using U.S. Treasury rates can be an alternative strategy. These rates usually trigger an inverse response from gold prices, as most traders will liquidate their assets to purchase Treasury bonds. So, gold prices tend to move downwards whenever the Treasury rates increase. And whenever the Treasury rates decrease, the price of gold increases. When interest rates are low, investors may be more inclined to hold on to gold as a store of value. On the other hand, when interest rates are high, investors may be more inclined to invest. In these cases, gold traders would opt for bonds or other fixed-income assets, which offer a higher rate of return. By monitoring this relationship between gold prices and U.S. Treasury rates, traders can identify potential trading opportunities based on interest rate fluctuations. For example, when the U.S. Treasury yield rose on Thursday, the 17th of March 2022, the gold prices dropped below $1,946. Although it hit that price again a few days later, it dropped below the resistance at $1,925. Technical strategies. How are you? Edit this text, or upload a file. Click play, and I will read it aloud. Experienced traders often use technical analysis strategies as a guide to analyzing gold price charts. It requires advanced knowledge of technical analysis tools to identify patterns or trends that can help predict future price movements. Technical analysts use a combination of indicators such as moving averages, relative strength index, RSI, and the stochastic oscillator to identify entry and exit points. To use technical analysis to trade gold CFDs, ensure your strategy matches the current market conditions. Momentum strategies tend to work well in trending markets, while range strategies work best in low volatility markets. The moving average crossover. A simple moving average, MA, indicator is the average closing price for a traded security, often over 20 days. Gold traders also use the 50-day and 100-day MA. So how does the moving average crossover work? It involves plotting 2 mega-amperes of different periods on a price chart and looking for a crossover point where the two lines intersect. Whenever the short-term MA crosses the long-term MA, that's a signal for a possible long position on a gold trade. Whenever the short-term MA falls below the longer-term MA, that's a signal for a possible short position. Let's look at an example below. For example, you're in a hypothetical gold position as you use the 100-day MA. Whenever the 50-day MA crosses the 100-day MA, you can take a long position on the trade. Once the short-term MA falls below the long-term MA, that signals a possible short position. As shown by the MA cross above, gold enjoyed one of the biggest rallies during the 2020 pandemic. 4. In April 2020, the 50-day MA crossed the 100-day MA, and prices soared over several months until November 2020. Gold in 2020 was observed to hit highs of up to 25%. 5. 4 things to consider before trading gold CFDs. Here are 4 key things you should consider before start trading gold. 1. Find out what moves gold. Market forces have a direct impact on the price of gold. These forces directly affect the trade volumes, trade intensity, and market sentiment of gold. They include emotions, greed and fear, supply and demand, inflation and deflation, government policy. Supply and demand, for example, have played a significant role in the price of gold over the past couple of years. According to the World Gold Council, the annual demand for gold rebounded in 2021, recovering from many of the losses incurred during the 2020 pandemic. Because of this sharp increase in demand from institutional investors, the prices of gold bars and coins shot up to levels not seen since the second quarter of 2019. 6. That wasn't true, however, for every gold instrument. As some shot up, others dropped. Take gold ETFs, for instance. An increase in interest rates and inflation across Western markets made it expensive to hold them, leading to an outflow of capital from gold ETFs into other assets. Failure to understand these forces can expose you to massive market risk as a retail trader. That happens when you trade on one sentiment when, in fact, another controls the market. 2. Understand the market participants. Gold attracts multiple market participants, each with opposing interests. In other words, everyone in the gold markets has their reasons for participating. Understanding these interests can help you determine how to trade gold and which gold instrument to choose. Most times, gold bugs, or investors with a bullish outlook on gold, are at the top of the pyramid. These investors purchase actual gold bullion and other gold assets. Gold bugs traditionally hold long positions, sometimes perpetually, and are rarely shaken by downtrends. 7. Although their actions elbow out shorter-term market players, gold bugs create enormous liquidity in the markets and provide opportunities for other players to get out of their gold stocks and futures positions. Gold also makes for an excellent hedging instrument, and most institutional investors will use risk-on and risk-off strategies, especially in markets with lower retail trader participation. 3. Observe for long-term gold trends. Gold has a rich history. Take time to go through historical gold charts and understand its behavior over the past century. Trend watching can help you identify patterns that gold has followed over recent decades. 4. Choose where to trade. Once you understand these 3 factors, you can choose where to trading platform. Doing this provides you with an opportunity to select a gold CFD instrument to trade and plan your entry and exit points. At the same time, liquidity follows gold trends, especially during upwards or downward movements. Markets with lesser participation are less liquid and have much lower participation rates. Often, they'll force higher trading costs on you through slippage. Conclusion: trading gold requires patience, discipline, and a long-term outlook on gold strategy. Although there are plenty of gold trading strategies, consider getting started with these 3 first. To recap in short, fundamental strategies help analyze market statuses, while a technical strategy enables you to time your entry and exit out of any gold positions. Whichever strategy you prefer, it's essential to reflect on market forces, risk management, and your personal financial goals before trading gold. And remember, past performance is not an indication of future results. So choose the right strategy that fits your trading style, and trading gold can be a profitable investment. Happy trading!
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.